Welcome to vTalkInsight, Risk Sentiment Daily for January 12, 2026. Global markets are leaning into a cautiously risk-on tone, with equities grinding higher even as policy and macro risks accumulate beneath the surface. Today we unpack how that balance is shifting and what the latest moves in housing, earnings, rates, and geopolitics are signaling for risk appetite across portfolios. Risk sentiment is broadly constructive, but with a clear layer of caution underneath. Equity markets across Asia and Europe are posting modest gains, and the main United States equity benchmark has climbed, with implied volatility back in the mid-teens. At the same time, volatility across equities, foreign exchange, and rates is described as notably low, signaling a willingness to add risk, even as investors recognize that the macro backdrop is far from risk-free. Underlying this cautiously risk-on stance are resilient United States fundamentals. Consumer demand remains solid, hiring is slowing but still positive, and inflation is trending lower. Credit spreads are tight, bank shares are strong, and small caps and cyclicals have started to participate more meaningfully in the equity advance. Yet the same commentary highlights several pressure points: mixed labor data, doubts about the pace of Federal Reserve rate cuts, rising fiscal deficits, and a dense calendar of event risk from jobs reports to Supreme Court tariff decisions, all of which could challenge today's benign, low-volatility regime. Investors are responding with a barbell mindset. On one side, there is clear appetite for growth exposures, from AI-linked technology to housing and energy-sensitive assets. On the other, there is renewed interest in classic hedges such as gold and long-dated treasuries, alongside a focus on higher quality credit. That mix points to an environment where risk-taking is still being rewarded, but where the margin for error is shrinking and where policy surprises or macro shocks could rapidly flip sentiment from comfortable to defensive. A key bullish driver today is policy-driven housing and mortgage support. Fannie Mae and Freddie Mac have already purchased around $65 billion in mortgages over the past 5 months, with scope to expand their balance sheets by up to $200 billion. Alongside a larger government initiative to buy mortgage-backed securities, this has been interpreted as a form of mortgage quantitative easing, with the Treasury and agencies working to compress mortgage spreads and stabilize long-term borrowing costs for households. These actions are already feeding through to markets. United States mortgage rates have dropped below 6% to a near 3-year low, and home lender stocks have surged as investors price in a policy-driven boost to housing affordability and agency profitability. The combination of direct mortgage purchases and plans to limit institutional investment in single-family homes signals a political focus on homeownership, which in turn supports construction activity, household balance sheets, and risk sentiment around housing-related equities and credit. There are, however, important constraints and risks. Structural housing shortages mean that affordability cannot be fixed by rate tweaks alone. Supply needs to rise materially. Many homeowners are locked into sub-4% mortgages, reducing mobility and capping how far policy efforts can boost turnover. In addition, rising government intervention in housing raises concerns about long-term market functioning and fiscal costs. While near-term sentiment benefits from mortgage support, investors are increasingly aware that these policies add to the broader fiscal and regulatory overhang that could weigh on long-duration bonds and parts of the equity market over time. Another important bullish engine is AI and broadening earnings strength. Taiwan's semiconductor manufacturing reported around a 20% year-on-year revenue increase, beating expectations, driven by strong demand for graphics processors and data center chips tied to ongoing AI investment. Those results have lifted sentiment across the global chip supply chain, with European semiconductor equipment makers such as ASML benefiting and reinforcing the narrative that AI-related capex and productivity gains are still in the early innings. Crucially, the earnings story is no longer confined to a narrow set of mega-cap leaders. S&P 500 earnings are expected to grow by around 10% this year, with energy, industrials, materials, and discretionary sectors all cited for strong potential and reasonable valuations. Market breadth is expanding as small caps, as proxied by a strong start to the year in the Russell 2000 and the bank sector, with a major bank exchange-traded fund at record highs, participate more fully in the rally. Merger and acquisition activity in sectors such as healthcare also signals corporate confidence in future cash flows. Still, this upbeat picture comes with caveats. Semiconductor valuations are now being compared with levels last seen around the year 2000, raising clear asset bubble concerns if earnings trajectories or AI adoption rates disappoint. Megacap technology earnings have grown roughly 5 times faster than the rest of the market over 5 years, sustaining high index concentration. Combined with low volatility and strong consensus optimism, that leaves equities vulnerable to negative surprises, whether from earnings misses, regulatory actions, or shifts in capital expenditure plans, even if the medium-term AI and productivity themes remain compelling. The third supportive factor is the soft landing macro and measured Fed easing narrative. Recent payroll data show clear signs of cooling. Annual payroll growth of roughly 584,000 is the weakest since 2020 and below pre-pandemic trends, and the latest non-farm payroll report came in around 50,000, with downward revisions to prior months. At the same time, the unemployment rate has edged down to about 4.4%, and wage growth remains close to 3.8% year-on-year, suggesting a labor market that is slowing but not collapsing. Against this backdrop, markets are converging on a view of moderate, delayed easing rather than aggressive cuts. Clean recent data have reinforced expectations that the Federal Reserve will not cut rates in January, and the first move is now widely anticipated by mid-year at the earliest. Current pricing implies roughly 2 cuts later this year, and commentary suggests that neither the softening in jobs nor the resilience in wages is enough to significantly accelerate that path, keeping the focus on a gradual normalization in policy rather than a rush to stimulus. For markets, that soft landing and measured easing mix is constructive. 10-year Treasury yields have traded in an unusually tight range despite economic shocks, and the 5 to 10-year segment of the curve is expected to remain broadly stable, while long-term yields near 5% are seen as attractive entry levels for extending duration. Resilient consumer spending, including a notable rebound in December card data, and disinflation trends underpin tight credit spreads and sustained interest in emerging market debt, where steep curves and high real yields in countries such as Brazil, Mexico, and South Africa are drawing in capital. On the bearish side, higher for longer Fed and yield risks are front and center. Expectations for a firm United States jobs report and a slight drop in unemployment have already raised doubts about imminent rate cuts. Several commentators warn that if labor data remain resilient, bond markets could face renewed selling pressure, particularly at the front end, as investors reassess how quickly policy can move from restrictive to neutral. There is concern that short-dated United States rates may be mispriced by as much as 50 basis points relative to a realistic policy path. A strong payrolls print with a declining unemployment rate would likely reinforce expectations for delayed cuts, pushing front-end yields higher and flattening the curve. The United States dollar has already moved to a 1-month high, supported by these higher yields and the perception that the Fed may keep rates elevated for longer, which can tighten global financial conditions and pressure more rate-sensitive and leveraged parts of the market. This higher-for-longer concern interacts uneasily with the soft landing narrative. One identified risk to the current Goldilocks setup is a rise in layoffs. If firing picks up meaningfully, markets could swing rapidly from worrying about too few cuts to anticipating a deeper downturn, pulling long-end yields lower for the wrong reasons. In both scenarios, the common theme is greater rate volatility than current pricing implies, suggesting that today's comfort with stable yields may be vulnerable to surprise shifts in either growth or employment data. A second key headwind comes from rising fiscal deficits and policy intervention. Major economies are running average fiscal deficits of around 6% of gross domestic product, with debt burdens near 100% of output, a trajectory described as unsustainable. In the United States, the prospect of an additional $500 to $600 billion in defense spending is flagged as not yet fully priced, adding to concerns that persistent deficits will keep bond yields elevated and eventually test investor demand for long-duration sovereign debt. Persistent fiscal shortfalls are expected to undermine the traditional hedging role of government bonds. If deficits keep term premiums high, duration may no longer rally as strongly during equity drawdowns, weakening the classic stock bond diversification that many portfolios rely on. Some commentary notes that investors are increasingly focused on this risk, particularly for long-dated treasuries, where rising supply and policy uncertainty could exert ongoing upward pressure on yields, even if the Fed begins to trim its policy rate. At the same time, government intervention is expanding across sectors. Housing support via large-scale mortgage purchases, new rules limiting institutional ownership of single-family homes, and active management of oil flows and energy policy are all cited as examples of a more intrusive state. While these moves can create tactical opportunities and sectoral winners, they also introduce unpredictability, raise the risk of policy mistakes, and may cap equity market valuations by increasing regulatory and fiscal overhangs, particularly as investors look ahead to future election cycles. The final bearish driver is low volatility and tail risk complacency. Market volatility expectations for treasuries are extremely subdued, and realized volatility across equities, currencies, and rates is also very low, even as multiple risk events cluster on the calendar. Bond markets are stable ahead of key triggers such as non-farm payrolls and a pivotal Supreme Court decision on tariffs, but this calm raises the question of whether investors are underestimating the potential for a sharp repricing. The list of potential catalysts is long. A Supreme Court ruling on United States tariffs could create significant legal uncertainty, force complex refund processes for companies, and potentially prompt new or placeholder tariffs, all of which would weigh on trade flows and business confidence. Geopolitical tensions around Iran, Russia, and Venezuela add to the mix, with protests and instability in key producers threatening energy supply. Despite weak headline oil prices and deeply bearish institutional sentiment, record short positions and tight physical market signals suggest that any disruption could trigger sharp upside moves in crude. Markets are sending mixed signals in response. Central banks have doubled their annual gold purchases since 2022, consistently buying over 1,000 tons a year, while investors are turning to gold exchange-traded funds as doubts grow about Bitcoin as a reliable hedge. At the same time, concerns about stretched equity valuations, particularly in semiconductors, and rising default risks in private credit highlight how a low-volatility surface can mask growing fragility underneath. The key takeaway is that today's plastic conditions may not fully reflect the range of outcomes that tariffs, geopolitics, and credit normalization could deliver. To sum up, markets are still leaning cautiously risk-on, powered by policy support for housing, an AI-driven and broadening earnings story, and a soft landing macro backdrop with expectations for measured Fed easing. Set against that are meaningful headwinds, higher for longer rate risks, unsustainable fiscal trajectories and growing policy intervention, and an uneasy combination of ultra-low volatility with sizable tariff, geopolitical, and energy tail risks. Watching how labor data, fiscal debates, tariff rulings, and volatility gauges evolve from here will be critical for understanding whether today's benign regime can persist or gives way to a more turbulent phase. This video is for information only and is not investment advice. Visit and subscribe to vTalkInsight.com for latest interactive market insights.